All righty. Good morning or good afternoon, everybody. Hope you are well. All right. So let me talk about today. This is the next class that we just ended a class. We do a monthly online class for the public, and we just finished one, short-term flies and calendars. I think it was a very good class, very practical going through this market. And I was thinking, what do I think could be the most useful class for the next month? And I came up with credit spreads. And you say, why? Because we have a bit of a range going on in the market and really nice high volatilities, good premiums, which makes it a wonderful opportunity, I think, for credit spreads. What does it translate higher volatility into credit spreads? What does that mean? It means you get more of a credit, but much more important, you get much more the distance, much more room out of the money. So I just think this is a very good environment in the market for teaching this. I think credit spreads are one of the more popular strategies. How many of you do credit spreads on, maybe a little bit or a lot? How many of you do credit spreads in one form or another, maybe a little bit or a lot? And so I think they're one of the simplest strategies to understand. I think they're, one of the great benefits of credit spreads is you're eliminating risk in one direction. And another thing is the way you set them up, whether you do calls or puts, you can set them up with really good probability in your favor, a high probability of success right off the bat. So I think they're for people that aren't used to doing it themselves, right? I think this is a very good, easy spread they can do. And obviously risk management is key, and we're going to go over that. But we're going to talk about just today a little bit about it, and what I'm going to cover in class. But the idea is a credit spread plan. This will be the name of the class, for generating 5% weekly. So we're going to look at short-term trades. And again, the reason I'm doing this, I just think it's a great environment for it. I think the premiums are really good. You have a good VIX at 30. And so what I'm going to do is, let's face it, how many of you would love to have one strategy, just one, that you can do well and generate a couple grand a month? How many of you would like to just have one, right? Forget 3 or 4. So I think this is that type of, here's a strategy, right? And we trade many strategies. We work on the craft very hard here. But here is, I think, an opportunity to take a strategy, a simple strategy to understand, a simple strategy to apply. There's not 4 legs of it, 3 legs of it. And I'm going to give you really simple plans, right? This isn't going to be anything where you need, making things complicated. This is something I think a 5th grader can understand intellectually, right? I think most of options a 5th grader can understand. I don't think for most of you, I'd say 100% of you, it's not an intellectual problem if you're not being consistent with options, obviously. But, it's that having a disciplined plan and sticking with it. So this is going to be a 4-week class. I'm going to get into it in a second. This is going to be a 4-week class. So the whole purpose is we're going to do it 4 weeks with you, right? Every class is going to go Tuesdays and Thursdays for 4 weeks. Every class will be recorded if you miss some. But I'm going to put on live trades every one to illustrate it, right? But again, if you miss a class, you say, I miss it. I didn't get the live trade. Here's the beauty of it. We're going to actually do something weird. We're going to explain what we did. So even if you miss it, you'll know how to, if you go in the next day and do it, right? So this isn't anything mystical, right? Nothing mystical. And we're going to do this together. So what's nice is over 4 weeks, you're going to put on 8 credit spreads, right? Is that good practice to put on 8 live trades together? Is that good practice? Yeah. Now, of course, do I know everybody's level of experience? No, so I can't. But, you can do, if you have no experience and you barely can use your brokerage platform, what would I recommend? Do 1 paper trade, right, each time. If you understand options, you understand your brokerage firm, ideally you'd like to do 1 contract, right? Because it is different trading live than paper. Class information, it's a 4-week class. Starts Tuesday, May 26th, a week from this coming Tuesday for 4 weeks. Class times are 1 p.m. Central. All classes are recorded and archived. You have a class page with recordings and all PowerPoints and slides, and that'll stay up for a long time after the class, months and months. You have a Q&A button on the class page for your convenience. Even months after the class, you can ask questions on the material that we went over. The cost will be $397 for the 4 weeks. Each class probably will go close to an hour, and there'll be live trades every class to show you the craft. The idea is we're doing it together, and the goal is after 4 weeks, you're starting to get some independence, right? You've done it with me. All right. And the great thing is, do we know what the next 4 weeks hold in the market? No, right? We never will. All right. And these are some of the, I may add to this. This isn't everything all inclusive, and I may exclude a few, but this is a general kind of the key is we're going to give you a simple, very simple methodology that you can do to automate this even and put it on. But we will give a little more beef to it, so you can avail yourself to that, right? We're going to make it simple, but we do want to give you some information so you have it. So these are some topics we'll cover, just so you know. Ideal duration for generating 5% weekly yields. What is the best strike to sell with credit spreads in our opinion? What's the preferable width of credit spreads? Do put or call credit spreads have better probabilities of success in SPX and Russell? If you're afraid, what are 2 great methodologies to hedge your credit spreads? How to reasonably increase your capital with credit spreads. And again, there's different ways. If you're newer, you could trade SPY or IWM, which is 10 times less expensive. Also, whatever width we do in SPX, you could do half the width. So there's cheaper ways to do this. Just real quick, some other topics before we go through a few examples. Why is this one of the easiest strategies to master? What technical indicators should I look at when trading credit spreads? And I'll be having Jay Bailey, who works with us, talk on that one. He's one of the better ones, that really good at that, that we would use for these trades. Best adjustment, in our opinion, for the upside and downside for credit spreads. And believe it or not, they're different. Trading the upside is a completely different experience in credit spreads than trading the downside. I don't use the same tools. Simple risk management for credit spreads, even a beginner would love, right? And then, let's see, I think this is my last one. How expected range and standard deviation can increase your probability of success with credit spreads. How to get good execution when trading these. What to do when you have big moves. When to turn a credit spread into an iron condor or butterfly. A little more advanced. You don't have to go that way, but I want to give you that information so you have the tool. And then best stocks. What do we think are the best stocks to trade credit spreads in? So those are some of the topics we will cover, but the meat and potatoes will be, we're going to put a trade on and we're going to do this over and over again. Just like if the class was how to build a deck, every class we're going to build a stinking deck, right? And after you build 8 decks, you'll be much better. So it's got to be the practical experience with these live trades, and no matter what happens, how do we deal with them so you can see? All right, let's jump in. So as we look at the market today, all right, a couple things we're looking at, over the last, this is roughly the last month in the SPX. This is a 6-month price chart, right? Here we go, very nice and quiet into February. Then we hit the Niagara Falls. Then we come back, and now we've kind of range bound the last month. Would you agree? Range bound, got a nice 200-point range or so. Yang said, I'm not sure how to set the stop and adjust. Will the class cover these topics? Absolutely. Under risk management, we will tell you how we, what stops we use. Do we use stops? How do we get out of an order out of a credit spread when it goes against you? So all these practical considerations, what not to do. We don't like to turn stop orders into market orders because that usually doesn't turn into a good experience. So we'll talk about all the logistics, all the practical issues. And again, as you're going through these, you have access to ask questions also. So there'll be nothing left out or that we won't cover. Again, you can ask questions during class. If you're not going to be at a class and you want to ask questions, send them to me. If you want to ask questions when you're watching it recorded, you can do that. So we're in a range, and you have a nice volatility, right? The VIX, to me, the range that I'm trading to make my decisions on strategies is kind of, I'm looking at VIX, and I think this will continue over the next month, 25 to, you can say 40 to 45, let's call it 42. And so it's different, in this environment, pre-February, before the market got destroyed, the VIX range might have been 12 to 17. We're in a different environment, right? And so this is dictating kind of what I do, and we'll talk about the various things. But I think to make a long story short, I think we're in a process, right? Which most of you think, I don't, whether we go up or down over the next 6 months, I don't know. I mean, my guess would be we'd go higher than lower, but either way, ultimately I trade what's in front of me, right? I trade what's in front of me. We don't trade out of fear. We trade what the market kind of gives us, but we trade very, solid strategies, good probabilities, and solid risk management. And we do it over and over, and that's it. I mean, and so again, we have a nice volatility, and that's what triggered me to do this class. When you do credit spreads, which I'll show you here, let's look at a graph. Let's start here. Now, this is a 7-day credit spread. How many of you like shorter term credit spreads, A, or longer term credit spreads, B? A, shorter term spreads, B, longer term credit spreads. Mostly in the class, we're going to cover shorter term spreads. I will talk about longer term when we would apply them. The focus will be on shorter term credit spreads. To get 5% weekly, it's tough to get, I don't think it's possible, getting 5% weekly in longer term credit spreads, unless you pick the direction correct every week. But I'll be using shorter term credit spreads, but I will still address longer term a little bit. What do I mean by shorter term? Shorter term, I'm probably looking at a range of 7 to 17 days in that area. So here's an example of a 7-day credit spread I looked at today. Why did I use a 7-day with the expiration May 22 because I'm doing the webinar today, right? So I use the Friday. Yeah, that's why. I mean, so 7 days out would be a week from today, which is May 22. So here would be an example when I took this slide at 28.48. Again, this is just a slide from Thinkorswim. The green graph is the expiration graph, so that would be in 7 days. This is the graph, the purple line today. Over the next 7 days, this will morph into this line, right? So I'm selling with us at 28.48. I'm selling the 27.30 puts, right? Selling one and buying one 27.20 puts. And we'll talk a lot about width during the class. What's the best width? I'm just using this for an example. The credit is $1.50 and the margin is $8.50. How do I get that? The risk of a credit spread, you simply take the distance between the strikes, so 10. So if I have $1,000 of risk for one, less my credit of 150, so my margin or risk or capital that I have to put up at the brokerage firm to do one would be $850, right? That's my risk. And I'm doing it for a 150 credit. So if I'm looking to make 10%, it's not 10% of the credit, it's 10% of the margin, right? So on a 7-day credit spread, I get about 118 points out of the money. And this expires a week from Friday. Is that good? What's the expected range over the next 7 days? An expected range would be another name, standard deviation. And the expected range is 100 points. What does that mean in English or Spanish or Norwegian? It means if we're at 28.48, and let me just make it 28.50, you say why? Because I can do math better on 28.50 than 28.48. So let's say we're at 28.50 right now. What this expected range is telling me, right? This is where we're at now, that the expected range over the next 7 days, SPX is going to be between 27.50 and 29.50. And there's a 68% probability one standard deviation will be in that range. That's what that means. How do you do that? Well, you can get that on your brokerage firm, or you could just figure out a standard deviation. Calculation would just be, if you take the underlying, which is 28.48, one way of doing it, multiply it times, I usually, if I'm doing May 22, I look at the call and the put at the money and take the average, right? So if this is the volatility, 33.5 of the call, or excuse of one strike, and this is of another 33.34, I might take a volatility that represents my options. So I might take 33 and then multiply that times, if I want a 7-day standard deviation, my number here would be 7 divided by 365.25 square root. Now, this number may be different than Thinkorswim's expected range. I'm doing it by hand, but I like my number better. Their number may not be reflective of what I'm using. They may just be using a different volatility, but it should be close. So if I take, first I'll do, so I have 28.48 times 0.33, and then I'll figure out for 7 days, 7 divided by 365.25 equals square root. This part of the equation would be 0.13. So I'm going to multiply 28.48 times 0.33 times 0.13, and the answer is I get 122. right? They said 100, I'm getting 122. So what's the difference? I'm using a 33 volatility. My guess is if they got 100, maybe they're using a, 28 or something like that, right? But anyways, so this gives me an idea over the expected range over 7 days. But again, which we'll talk about, whether I do a 7-day or a 14-day credit spread, and we'll talk a lot about this in class, how many of you think it's better to stay in the credit spread the entire duration and get the entire credit, A, or B, how many of you think it might be optimal to get out sooner and take less? Yeah, I mean, I would say B, but there's nothing wrong with A, and I'll cover those possibilities in class, but it's got to be a plan that makes sense. And the thing against A is the longer you trade in something, the longer it can move against you. That's the key. So, but the key is consistency with these things, right? Consistency. And it all comes down to, are you going to keep your losers not far from your winners? And it's just discipline and understanding how to do this. And so by doing 8 trades with us, I think that'll give you a ton of confidence. And maybe even if you do these things on a regular basis, give you maybe some tools and ideas that maybe you haven't thought of or you haven't applied. And if you can get one idea out of this, I'm sure you'll get a lot more than one, but if you could get one good idea, that's going to be well worth it for you. Rick just gave some ideas how he thinks that TOS calculates it. But again, there's some flexibility in those things in terms of volatility. Again, I like to use a volatility that represents the options I'm playing with. So let's talk about this a second. So here we're doing a credit spread at the 27.30 strike. Generally with a credit spread in the put, you'll be a little bit long. They generally have a low gamma, meaning because they're so far out of the money from the current price, the deltas don't change. It doesn't go against you quickly, right? You've got some room, right? It's like you're in the Kenyan forest in Africa, and there's tigers around, but right now they're about 4 miles from you, right? So it'd be a pretty low gamma, right? And you've got some room, right, with these things. So it's a positive theta for a 7-day. And if volatility goes down, you benefit. So we'll show you how we use the volatility ranges on these things. Generally, I do these credit spreads. If I'm doing them on a weekly, I might have a 2-day window or 3 to put them on, because even though price risk is the biggest foe of credit spread traders, volatility does matter some, right? Some, depending on your duration, not as much with short term. So here's a 7-day credit spread, and you can see the Greeks on a 7-day, and we're going to compare that with a little longer term in a second, just so you can get a feel of the differences between these things. All right, so let's compare this with a Darren says, do I put these on Fridays? No, I generally put them different days, and we'll go over that more in class and some of the pluses and minuses of all that. But, Darren, if let's just say you had a free day, right? Let's say Friday was the only day you were off from work. You know what? Friday would be my day, right? There's pluses and minuses with putting them on Fridays, but I think what trumps maybe the ideal day is being consistent. And so I don't have a huge problem for short-term strategies. Would I ideally put it on Friday? No. This class will be going on Tuesdays and Thursdays. Those are kind of my ideal days, and I'll give you many reasons for that. Why I like to put short-term trades on Tuesdays and Thursdays. That's why I'm doing the class on Tuesdays and Thursdays, and we'll talk more about that. Credit spreads are quite directional compared to an iron condor. They are directional compared to an iron condor. I mean, they're more directional than an iron condor. I mean, they're not as directional as you think. I mean, when you think about it, here's a credit spread that we're doing, and we're 0.76 deltas long, less than 1 delta, right? So this is a 35-day credit spread, this example. But if you wanted to get long or short, Kevin, and you bought a 50 delta call to get long, like an at-the-money call, or you bought an out-of-the-money call at 20 deltas, is that a lot more directional than something that is less than 1 delta long? Right? Do you see that perspective-wise? This isn't that directional if you compare it with what people do directional, right? I mean, and the other thing here is you can make money if it goes against you. In a put credit spread here, you make money if it goes up. You make money if it sits, if it stays in a range. I mean, you need quite a move down to lose money. There's only one scenario. Do you select a delta to choose the short put? Yes, we do. We do look at deltas to pick the short put, and we'll talk about that. I mean, it varies, right? And I'll go over all the differences. Generally between maybe a 10 and 30, but I think it's crucial when we would use a 10 or a 30 or maybe even a 40 in there. But let's compare the Greeks here a second. So let's compare a 35-day credit spread and a 7-day. And the first thing would be this is a symbol for deltas. On a 35-day, what you're looking at, your deltas are 0.76, again, less than 1. If you're within on any position, 1 or 2 deltas long or short, that's pretty neutral to me. On the 7-day, our deltas were 1.65. And I think of these two examples, at least these class examples, I was selling a 19 delta for the put. So they were similar. Except if you're doing a 35 days, what's the difference between a 35 day is able to get a lot further out of the money than a 7-day, right? But expected moves a lot bigger on a 35 day. Gamma just means how quickly the trade will go against you delta wise. And again, credit spreads are pretty out of the money. So the gammas are a lot less than other trades like a butterfly or something. So the gamma is think about it. The Greeks give you a 0 gamma. There's got to be some gamma to it. But when you're doing 35 days out, because you have so much room to the short strike, these things move against you very slowly. The next thing is theta, positive decay. Obviously, you get much more, right? 10 versus 1.93, about 5 times the theta or time decay in a 7-day is a 35-day. And that's the big plus to 7 days is your theta. But price risk is a bigger deal. And then, but if you look at like price, Vega-wise, The 7-day is minus 6.25, and this was minus 5. So they're kind of close. But what you can see is for the 7-day, you're bringing in $1.50 credit. The 35-day, you're bringing in $1.60 credit or $1.50 credit. I mean, they're both pretty similar. It was $1.60 for the 35-day. You're bringing 10 cents more. And again, these are very comparable because you're doing a 19 delta for the short put. But the difference is, again, and I think why 7 days are more attractive than 35, because, you know, if you do a 35-day trade, you might be in it 2 or 3 weeks. Whereas these, you're putting a new one on every week so you can turn your inventory over and make more money, but you still have to deal. You say, why do people do 35 days versus 7? You can absorb a price move more, right? There's a lot of benefits to this. Overall, in Sheridan Mentoring, we love long-term and we love further out. I like to diversify. So if I had 10 grand of credit spreads, I would probably do, as a rough guideline, 70% in 30 to 45-day credit spreads and 30% in 7 to 17-day. Diversify, right? And that's a good way of doing it. So I'm excited about this class coming up. I think it'll be a big help to you in that it'll be very systematic. You'll be getting a system, but unlike a system, right, that depends on the guru doing it. 99% of the time is not a guru. I don't even know what a guru is. But this will be something that every step of it will be explained to you, right? Right? Every step will be explained what we're doing, right? And the profit target and max loss, yeah, that will be talked about in class. That will depend. I'm going to give you some much more guidelines on that as general. I'll give you guidelines. We're in a higher volatility environment right now and how I might tweak it if we get lower. But again, we'll talk about that because there's a few different considerations in there instead of just whipping out a number. So I want to make sure we teach you properly. Again, we'll be putting on 8 credit spreads together, going through them. Simple methodology, but we're going to be building up around it so you know what you're doing, right? And we're going to talk about key and many credit spread systems. People will give you things to do on the downside that I wouldn't wish with my worst enemy, right? So I think, you know, it's crucial, you know, that you understand what are some things you can do on the downside and what are some things that don't work as well on the downside as the upside. And things like back testing and other stuff won't tell you that, right? Until you're in the heart of the situation and you say, ooh, this doesn't work real well on the downside. Downside's a different animal. Downside is like Chicago weather. The upside is like Miami Beach weather. It's different, right? Can't, in my opinion, the adjustments that you use on the upside, you can't use on the downside, right? And especially in extreme cases. The downside is like Pac-Man level 3. The upside is like Pac-Man level 1 in most cases. So folks, we'll be starting up a week from Tuesday. Again, I think it'll be one of the more practical classes you've ever done, whether you're beginner or advanced. I think you'll get a lot out of it. We'll give a lot of meat for the intermediate and an advanced trader, but the beginner, we're taking you by the hand, right? And you're going to get 8 of them, right? And whatever the market brings at you. So folks, what you do is you just go to, I don't know if the link's up there yet. I don't know if Johnny's got it up there yet, but it should be up in the next couple days. And we'll send you the link in the mail. But you go to SheridanMentoring.com. It should be up on there in the next week. Is there a system or platform or options journal required? No. No, there's no platform that you need to buy or something. Again, this is a very simple, Mark. I mean, it's simple. There's a lot of seriousness and a lot of experience behind it. And we'll give you a lot of stuff, but no, you don't need a special platform and a special journal. And is there techniques for what if up or down the market? Yes. We'll deal with the up market. Techniques for adjusting the up and down market. We'll give some thoughts on which direction we would do. But I'm looking for a very consistent approach. And I'll be teaching most of the 8 classes. Jay Bailey, who works with me for 15 years or 13 years, whatever, is excellent trader and phenomenal with technicals and that stuff. And I'm not with technicals, so he can at least a lot of the metrics that we look at, and that'll be a big help to you. He's very, very thorough. He's an engineer by background, so he's very thorough. All right, folks, look forward to seeing you a week from Tuesday. It'll be a 1-month class. We'll be meeting every Tuesday and Thursday at 2 Central, and every class will be recorded. And what I'll do is after each class, probably within 20 minutes of each class, I will email out the class trade I did with the risk management, just so you can keep up with it, right? The key is risk management, right? And that's what we're focusing on. And that's going to sink you. Right? And so that's what we're going to focus on is, if you talk to any credit spread trader in the business, how'd you do last year? I did great. 1 month took me down. 1 month, I had a bad month. And that's what we're trying to do, is give you a simple plan, but you need to do it. Our goal here, we're trying to teach you to do it, right? We're not having you rely on us. We want to teach you to do it. So this is a great opportunity over the next 4 weeks, and we will see you soon. So thanks, everybody. Appreciate you coming. Thanks.